Okay, well, let's take a look at this little exercise we have here. And it is titled Reporting Uncollectible Accounts and Accounts Receivable. So, one thing I do want to point out is that in a previous exercise we looked at the percentage of sales method, which is a perfectly acceptable method for analyzing, well, let me back up. I don't want to use the word analyzing. For determining bad debt expense and the allowance for credit losses. But now we're going to use the analysis/aging method. And so the analysis method and the aging method are the same thing. Okay? And this is important that we distinguish this method from the percentage of sales method because the way that we calculate the total amount between these two different methods will change. All right. So I think that most companies, I would say, I'm guessing, I'll just say the vast majority of companies use the analysis or aging method for accounts receivable. Percentage of sales method is perfectly acceptable though. All right, so I have gone ahead, we've got this company here, Lafon Company, analyzes, so I'm going to actually underline that word as well. It's accounts receivable at December 31st, 2016 and arrives at the aged categories below along with the percentages that are estimated as uncollectible. So, with the percentage of sales method, there is no analysis that goes on. There is, but once we establish a percentage that we're going to use for our bad debt expense, that percentage is based upon percentage of sales. So there's no analysis taking place of accounts receivable. So this is different. So what I did was we have the schedule here for the Lafon Company, and I went ahead and I just kind of calculated all of these figures out in advance to save some time. And so what we find is that total accounts receivable on the balance sheet is $381,000. But notice what we have going on over here. We say that current debt, we're going to essentially collect 99.8% of this $250,000 that we're estimating a credit loss of only $500 here. And then notice as the age of the receivables gets older and older and older, our uncertainty as to whether or not we will ever receive the money also increases. So notice down here at with accounts that are over 6 months old, fortunately we only have $4,000 of those, but we estimate 25%, 121 to 180 days overdue, 10%. So the good news for this particular company is that the vast majority of their $381,000 total is up here in these first two categories. $340,000 is up here. Okay. So we will need both of these figures here in a moment, but there's some additional information to look at. At the beginning of the fourth quarter, there was a credit balance of $4,390 in the allowance for uncollectible accounts. This is outdated terminology. Allowance for credit losses is, as of the time that this video is being made, is the more up-to-date terminology, but they mean the same thing. Okay? And so if we think about this when we, and maybe you don't know this, so maybe I should just tell you, when we set this up, allowance for uncollectible accounts or credit losses, whatever we're going to call it, is the other part of the journal entry for bad debt expense. So we hopefully know that anytime we have an expense that has a debit balance. So what does that mean? It means that this account here, this credit balance of $43.90, this is a normal balance. There's nothing out of the ordinary here. Okay, so that's the beginning of the fourth quarter. However, during the fourth quarter, the company wrote off $3,790 in receivables as uncollectible. All right. So what amount of bad debt expense will the fund report for 2016? Well, with the analysis method, we adjust bad debt expense based on a number of factors. So what we want to recognize here is we're going to use three numbers. We're going to use this $39.50 here, and this is the amount of our current receivables that we believe is going to be uncollectible. And we're going to add that to, and the way I'm going to set this up is I'm going to put the write-offs first, $37.90, minus the original credit balance amount of $43. Let's see here, $43.90. Yes. Okay, and that's going to give us a grand total here. Let's see here, $390. Better bring the calculator over here just to make sure we're doing this correctly. So $37.90 minus $43.90 that we had is $600. So what we're saying here is the amount of bad debt expense for the year is going to be $3,350. So it is going to end up being this figure of $39.50 adjusted downward by $600 because for the quarter our actual write-offs were $600 less than the beginning credit balance. Okay, and that's how we would do that. I set it up this way, and this may not help you at all. I don't know, but you know, I consider the write-off kind of the actual expense. So I have it over here on the left, and then the credit balance that I started off with is over here to the right because the credit balance has a normal right side balance. But anyway, that's just the way that I do it, and so we come up with $33.50. Okay. So the requirement B says, what is the balance of net accounts receivable that it reports on its December 31st balance sheet? This is a little bit easier. All we have to do is just take our gross amount minus our allowance or our estimated losses. And so this is very, very straightforward. All we have to do is just take $381,000 minus the $39.50 estimate of what will be uncollectible. And if we do that, let's see here, when we get $381,000 minus $39.50, and so that's going to give us $377,050 as our account receivable at net amount. Okay, so let's move some of this stuff around, including the calculator. And then we have one more section to do. So it says set up T accounts for both bad debt expense and allowance for uncollectible accounts. enter any unadjusted balances along with the dollar effects of the information described, including your results from parts A and B. Okay, so what I would do, how I would do this, if it were me, is I would start over here on this side, and my beginning balance is going to be this $4,390. See, it says at the beginning of the fourth quarter, okay? And I'm going to write that figure on the right side because this is a credit balance, okay? Then I'm going to enter my actual write-offs, which they gave us right here. I'm going to put that over here on the left, and that's exactly how I set this up right here. Again, I don't know, that probably doesn't help you any, but just in case, okay? Now, we need to actually come back up here and look at our amount of bad debt expense. And we said that bad debt expense has all expenses have a debit balance. So we're going to go ahead and enter that here over on the left side. Okay, and we're going to come over here and we're going to do the other side of that essentially journal entry, although we're using T accounts, just like so. So our bad debt expense is pretty simple. There's only one thing there, so we can just drop that down. Notice if you are doing this in a homework, make sure you pay very, very close attention to the instructions. It looks like we've got some shaded boxes here, and even if we don't use those, the instructions might want us to enter in a 0. Just depends on what they say. So let's come over here to the allowance for uncollectible accounts. And notice I wrote credit losses up here. That, again, is the more common or current terminology. So let's just do this. What I'm going to do is I'm going to say 4390 minus 3790 in write-offs plus an additional 3350 gives me 3950, and notice that that is the exact figure that we had in our aging schedule above for LaFond Company. All right. Well, hopefully that helps you understand a little bit more about the analysis / aging method for reporting accounts receivable at their expected net amount.